Welcome. Happy Monday. Ready to get started here today. Hope everyone had a great weekend. We have a great topic for today that we'll be going through here in a minute, but just like always, let's go ahead and wait just a couple minutes so we can get live on all the different platforms and we can give everybody a chance to jump on as well. We'll put the chat up. Anybody tuning in wants to go ahead and throw up a comment in the chat there. There we go. Taryn, good morning. All right, Jason, Manny, everybody tuning in. We're going to wait just a couple minutes here for everybody to be able to jump on. All right, some more people dropping comment in the chat as you tune in. Just waiting for everybody to jump on here. All right. Looks like we are live on all the different platforms, so we can take the chat off here and get it going. Pull up the screen. Welcome, everyone. My name is Kyle Hiersche. I'm the COO of The Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. Now, what we do every day on this show is go through the live rates, and then we go into a deep dive on a different topic. Now, today's topic is not going to be non-QM. It's actually going to be an FHA 203k loan. So a very complicated loan, not a very simple conventional loan or even a simple FHA loan, but it is still, again, not non-QM, but we still know how to navigate these waters here. So we'll have Jose go into a deep dive of that here shortly. But first, just like we do every morning, Nick, let's go ahead and pull up our pricing tool for our mortgage professionals, and let's check out the rates for today. It is April 3rd, just after 11 a.m. So let's check out what the market is doing here today.
All right, let me switch up my screens and we will get into it. All right, so as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. We have over 300 licensed loan officers and can do primary second homes in 22 states. And we can do our business purpose DSCR commercial loans in pretty much all states. So we're just going to go through our pricing tool today, which is going to show us the general rates and APR for our general programs. As Kyle mentioned, it is April 3rd, just after 11 a.m. Eastern. So all of our basic programs are live now with rates. And then, of course, Jose will go into a detailed program dive. But for our pricing scenarios, we're going to set up the same scenario for all of our different examples here. We're going to set up an 80% loan to value. That means 20% down payment. We're going to set a nice, easy loan amount of $400,000. We're going to set a desired price of $99. That means we're going to tell the computer to find our best rate options at one discount point in cost. Most of our customers want to buy down the rate a little bit in this market, so that's our typical request. And for our primary home loans, we're going to do our three examples, our conforming conventional programs. Then we'll go into our FHA programs, which will be our regular ones, not the ones Jose is going to go into with rehab. These will just be a standard FHA program. Then we'll go into our non-QM expanded guidelines. That's where we have over 5,000 additional loan programs beyond the traditional. We have VA available, but that's only for our qualified veterans. So if you are qualified, please get with us. We'd be happy to quote it. But since not everybody qualifies, we won't do it live. And same with USDA. That's only for a property that is qualified in a rural eligible area. So if you are shopping in a rural area, please get with us. We'd be happy to quote it. but we'll stick with the top 3 for our example today. So our first example, we'll do our conforming conventional. We'll do a purchase, 30-year fixed, standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. That's where our office is. And for all of our scenarios today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with all these basic settings, let's check out our conventional rates this morning. So looks like a little bit higher than it was on last week. So unfortunately, markets have moved a little bit in the opposite direction than we want. So right now, we have a 6.625 rate for 1 discount point in cost and a final APR of 6.801. So remember last week it was a little bit lower, but that's why we do the show. We love to watch it go up and down. Hopefully during this week we see some downward trajectory, but let's check it out tomorrow. Now, make sure to compare APR. Remember, APR always takes in all the costs. So as we go through the different programs, we'll want to key in on the APR so we can compare across the programs. So now if a customer, for any reason, doesn't qualify for one of the conforming options, which is usually typically the preferred option, we'll set up this same scenario. And for our second example, we'll go with FHA. Typically, FHA will allow us to expand our credit options, a little bit more leniency on the credit, and most importantly, a little more leniency on the debt to income ratio. However, we'll keep everything set the same here as we had for our conventional. And we will check out our FHA rates this morning to compare side by side. So it looks like the FHA has gone up a little bit. Typically, when you see the conventional go up a little bit, we see the FHA as well. So last week's show, we were a little bit under the 6s. Looks like this morning we are at 6.125 for a 0.75 discount point in cost and a final APR of 6.718. So right now, FHA and conventional look about neck and neck here in this scenario. Sometimes the FHA is a little cheaper. Right now, it's just a touch cheaper, even including the upfront mortgage insurance and yearly mortgage insurance. But that allows us to use the APR to compare it side by side. You see here, they're very comparable options. So now both FHA and conventional are in the high 6s for the APR. So let's compare that to our next option. We'll set up the same scenario. And this time, many lenders and banks and whatnot do not have any other options besides conventional and FHA. But fortunately, here at the Mortgage Calculator, that's really what we specialize in. We have over 5,000 additional loan programs under expanded guidelines, aka non-QM, and we can use alternative income documentation. So when we set the scenario up the same, set it to expanded guidelines, everything else will be set the same. However, we have a new option, income verification. So typically, full doc would be what we use, 2 years tax returns. That's what we use for FHA and conventional. So typically we'll switch to a expanded guideline option in order to take advantage of alternative income documentation, such as 1 year alt doc, 2 year alt doc, asset related. We do some shows on that if you're interested. Business bank statements, very popular. Investor DSCR, very popular for our investment properties. We'll do that in a minute. And our most popular program by far for our borrowers seeking to qualify under non-QM is going to be our personal bank statement, 12 months. That's going to be for our self-employed borrowers. Many times our self-employed borrowers, when filing with 2 years of tax returns, have various write-offs and for various reasons may not qualify using full documentation. So we will use 12 months of their bank statements and their actual cash positions in the bank to determine a debt to income ratio of 40% using their actual bank statements. So this allows us typically to qualify a self-employed borrower for much more income if they want to purchase a larger home, or if they don't even qualify at all, we can use these alternative income documentation methods to then qualify a borrower. So these are great problem solvers. Obviously the rates are going to be a little bit higher, but let's compare side by side here for this typical scenario. So let's check out our bank statement rates this morning. So pretty good options here. It looks like they've gone up a touch just along with the conventional stuff. So our top option here that the computer has found, actually looks like this will be the best option, the lower APR here. So this option, Alt Doc 30-year fixed, 7.5 rate for 0.75 discount points and cost for a final APR of 7.539. So remember, the conventional and FHA were in the very high 6s on the APR. This one is in the mid 7s, so very comparable. And remember, a customer will typically use these alternative documentation programs to qualify where they would not otherwise qualify, or qualify for more loan amount, therefore larger home, the home of their dreams, hopefully, that will allow us to use this income. So very comparable, side by side. The APRs are very reasonable, about a half a point higher in APR. Very good option for our borrowers that need to use these alternative income methods. So I definitely recommend everybody out there, make sure you get a quote to compare all your different options, and we have a plethora of them. Now, before we pass it over to Jose for the deep dive, we always want to do live rates on investment properties. We love to work with investors here. So we'll do our final 2 live rate quotes for investment properties. We will set up a similar scenario, 80% loan to value, 20% down payment, 400,000 loan amount, same we had before, same prices before. And we will compare our conventional investment properties with our non-QM investment property programs. Remember, FHA, VA, USDA do not allow investment properties, so we're simply going to compare these 2 options. So first, we'll check out our conforming conventional. Everything else will stay the same as it was before. So let's check out our investment property rates this morning. Now, remember, the Fannie Mae, Freddie Mac, the government entities that sponsor these loans have added fees here. So unfortunately, the computer can't find a rate with 1 discount point in cost. But the best option the computer found here is a 7.625 rate for 2.5 discount points in costs and a final APR of 7.851. So we love to quote these options for our borrowers that would qualify, but many times our investors would like to save money and choose a higher rate, typically for less discount points. But in conventional, you see here, we don't have many options for a higher rate with less discount points. So therefore, we would love to compare our non-QM options. So great options here for our borrowers that do qualify for conventional, but I always recommend our investment property customers in particular compare a non-QM option. So for our final scenario, we'll set up investment property again, 80% loan to value again, and this time we'll choose expanded guidelines. Now we have 2 new options. First, our income verification. When we're doing an investment property, our most popular program by far is our DSCR program, and that's because we don't actually require any income from the borrower, no employment information, no income information from the borrower. We're simply going to use the estimated rental income from the property to determine if that covers the expenses for that property, the PITIA of the mortgage. And if it does, that's a ratio greater than 1. We have a ton of programs for that. And we even have programs for a DSCR ratio under 1, meaning the property doesn't quite cash flow. So great options we have there. Please get with our team to quote that for you. There's a ton of different variations. And our final setting here is our prepayment penalty. So for a non-QM investment property, we're always going to typically have a prepayment penalty. So we're going to choose 3 years. That's the standard. But we can choose 0 if we so choose. That will obviously reduce the amount of loan programs we can offer and cost more. And we can choose 5 years as well. That's a little less common, so it'll reduce the amount of loan programs, but will save us a little bit of money. But for this example today, we always choose 3 years. That's a typical scenario. So let's check out our DSCR rates this morning. So we love to see our DSCR rates under 8, right? So very comparable side by side. This option here at the start, very awesome option, 7.99 rate for under 1 discount point in cost, 0.975. So this is exactly what we wanted the computer to find. And a final APR of 8.036. So very comparable. Remember, conventional rates were in the high 7s here in this example, and DSCR with no income, no employment, very easy program comparably is right there neck and neck with it. So tons of different options here though. Some of these options may allow things like short-term rental income. Some of these programs here you see with all the various different variations may allow things like a ratio under 1. Just tons of different options here. Here's an example of a ratio under 1. A little bit higher rate, obviously. So please get with our team. They'll find which one of these dozens of options work best for your scenario. So now that we've gone through the live rates, let's go ahead and introduce our deep dive topic for today. So let me go ahead and change my screens. And our topic for today is going to be FHA 203k loans. So Kyle talked about it a little bit earlier, and we did go through some live rates for FHA example. That was a pretty easy example, 20% down. This will be an FHA 203k example where I think Jose will probably have a little less down payment, and will typically include the repairs. So there's a couple different 203k programs. Basically, we're going to buy a property that would not otherwise qualify or need some repairs and finance those repairs into the loan. So we're not talking about a standard FHA loan. We're talking about a very specific type of FHA loan that allows us to include repairs into the loan amount. So very cool program that we have here. So go ahead and take over, Jose, if you're ready, and let the people know how this works.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. FHA 203k is a very useful program, especially right now when we have tight inventory. So there are many borrowers out there right now shopping for homes with FHA loans, pre-approved for an FHA loan, and they're having difficulty in the tighter inventory markets where there may be requirements from listing agents and sellers of properties asking only for conventional finance offers or cash only. So what do we do with the multitudes of FHA borrowers pre-approved looking for homes that have not been able to pull the trigger? Very simple solution, FHA 203k loans, right? That is a loan that will allow you to do one of two things. It will either allow you to buy a property that has damage, could be damage that's causing it to have code compliance issues, for example. So that would normally be a cash only deal. So you could buy that with financing, or it could be as simple as a borrower refinancing their current existing home and just making it bigger, making it more suit the needs that they need. So there are two types of FHA 203k loans here. You have a streamlined option, which goes up to $35,000 in total renovations, and you have the full or non-streamlined options, which does allow you to go higher than $35,000. Now, one of the things to note on the 203k loans, as with most owner-occupied construction and renovation type loans, the borrower cannot be the general contractor. So you will need a general contractor for this transaction. And that's very important to note because there are three parts to every loan approval for a 203k loan. We have to approve the contractor, we have to approve the renovation, and we have to approve the borrower's credit and income. Everything has to line up in order to be able to close this type of loan. So I'm going to have a couple of different purchase examples for you here. I'm going to have a streamlined example and a full 203k example. So in the first example that I have here for an FHA 203k purchase for 96.5% LTV, you'll note here some of the comments here I've put here, very important to note. Raising or demolition of the home down to its foundation is not permitted. And physical relocation also is not permitted. And as I mentioned, self-help is not permitted. So you do need utilities on. And if the utilities are not on, because it may not be feasible, then you will have to do an electrical test and pressure test, because FHA is pretty picky about those things. And real important also note there, accessory dwelling units, either renovation or construction of an ADU, is not allowed. This is because FHA is for primary homes. So this program is geared to a primary occupancy. So here you will note very good rates here for a renovation loan. You have lowest rate option 6.6% lowest cost option, 6.75%, with a lender credit of $1,203, and the lowest rate option, 5.375, with a cost of just under 3 points. So really good option for 203k. Now, what you also have to note on this program, that the final loan to value is going to be based on the after repaired value of the property. So it's very important that the renovations being done to the property do add enough value, and that the purchase price is competitive enough so that when you factor in the repairs to the home and the purchase price, we will still be at a maximum loan to value of no more than 96.5%. So really important to note on that. So this is for our full FHA 203k. Now our streamlined, as I mentioned, the difference between the full option and the streamline option is just that the streamline is for a maximum $35,000 repaired. So it is a little easier in terms of required permitting and paperwork, just a little easier. But you will note the rates exactly the same. So no difference here if you're going $35,000 streamline or if you're going more than $35,000 for the full 203k. Just no raising the property down to the foundation. So now we're going to throw a couple of extra twists here. This is the 203k option that allows you to combine it with the good neighbor next door option. Now, what is a good neighbor next door? Good neighbor next door is a sales incentive where the borrower has to be either a full-time law enforcement officer, teacher, firefighter, or EMT, right? So, and with this option, you're talking about $100 down payment. So very good option for our good neighbor next door applicable occupants. And again, the rate, same exact rate. That is the beauty of this. There are no adjustments for this 100% down financing option. And then there is one additional $100 down financing option when you're using the streamlined 203k purchase of a HUD REO. So, many times when borrowers are getting a HUD REO, which is basically a HUD foreclosure, those properties have condition-related issues that may render it not financeable under regular terms. However, the streamlined 203k can be combined with the $100 down option. And this is not for good neighbor next door. This is for any borrower that is buying a HUD REO, could combine the $100 down streamlined 203k program for the purchase of that asset that may have condition-related components that does not allow it to be financed under regular financing, be it conventional or regular FHA or any other type of financing option. And here, a little bit more limited in what we could do, but still you're looking at a 7.25% rate with a cost of just under 3 points. So still a good option for someone who wants to go $100 down on a HUD foreclosure. Obviously, a little difficult to land those foreclosure purchases right now. It's very competitive when any of them do go out on the market. But with this additional option, you could definitely open up some additional opportunities for your borrowers.
Great. That was perfect. Okay. Well, thank you. Lots of opportunity there that we can open up with that program. So that's great. Thank you everyone for tuning in. We do this show at 11 a.m. Eastern every morning, and we go through the live rates and do a deep dive into topics like this. And as you can see from this loan, there's multiple levels to each loan type, and you need a consultant to walk you through these different programs. So we have over 300 loan officers all around the country. We're licensed in 22 states for primary residences. And then also we can do investment properties, business purpose loans in most states. So if you need to be walked through one of these programs, you can go to themortgagecalculator.com, and one of our loan officers can walk you through and consult you through the process. And again, 11 a.m. Eastern every morning. We do this on weekdays so you can see how the rates are fluctuating and do a deep dive. So thank you everyone for tuning in. Thank you, Nick. Thank you, Jose. And we'll see you all tomorrow at 11 a.m. Eastern time. Take care.
Thanks, everybody.